Shortly after markets opened, U.S. Treasury yields began to rise for reasons that were not immediately obvious. There was no new inflation data, no surprise decision from the Federal Reserve, and no geopolitical headline large enough to explain the move. But by mid-morning, traders were no longer asking what had changed in the economy. They were asking who had stopped buying. Inside the Treasury Department, Scott Bessent was already working the phones, aware that when demand for U.S. debt hesitates without explanation, it usually means the problem is political, not financial. Bank stocks were sinking too. J.P. Morgan dropped more than 3% in a session that felt less like a correction and more like an early warning. When financials sell off alongside everything else, markets aren't expressing opinion, they're expressing fear. The assumption holding this system together, that U.S. assets are the default safe haven, was suddenly under stress. The catalyst wasn't hidden. Donald Trump had widened his trade war again, this time turning pressure outward toward allies. China had already been targeted. That alone rattled supply chains. But extending tariffs, threats, and geopolitical demands toward Europe pushed something more fragile: confidence. Global capital doesn't react to rhetoric, it reacts to risk. Europe sits at the center of that risk. Not rhetorically, mechanically. European institutions hold an enormous share of U.S. Treasury debt, roughly 40% of the foreign-owned market. That is more than China and Japan combined. For years, Europe has quietly financed Washington's deficits, while China steadily sold down its holdings month after month to levels now hovering around $682 billion, the lowest since 2008. That shift matters because the United States is running one of the largest deficit expansions in the developed world. Trump wants to rebuild supply chains, expand the military, confront China, pressure Venezuela, and even pursue strategic control over Greenland. Each one of those ambitions costs money. Add unfunded liabilities, social entitlements, and rising interest payments, and the arithmetic becomes unforgiving. The United States needs foreign capital. Right now, it needs Europe more than ever. Yet instead of reassurance, Europe is getting ultimatums. Scott Bessent, Trump's Treasury Secretary, delivered one of them in public. Speaking at the Davos summit, Bessent urged United States partners not to retaliate and not to escalate. He told them to sit tight, take the punishment, and let events play out. The subtext was unmistakable: do not sell treasuries. That alone told markets how fragile the situation had become. This wasn't the first time. After Trump's so-called Liberation Day tariffs earlier in the year, bond markets revolted. United States equities dropped more than 10%. The dollar weakened. Treasuries sold off. It was the first true sell America moment of this cycle. Bessent knows how that movie ends. This time, it could be worse. If allies begin dumping U.S. assets, the signal is catastrophic. Neutral countries don't wait for press conferences. They follow flows. China would have every incentive to accelerate its own sell-off, not as retaliation, but as leverage. Confidence collapses faster than liquidity ever can. The first crack in Europe came quietly. Denmark's academia pension began reducing exposure to U.S. treasuries. On paper, the numbers were small, around $100 million in holdings in 2025, not enough to move markets. But large shifts don't start large, they start symbolic. And this one carried a message fund managers everywhere understood. Buying U.S. treasuries now means funding Washington's military and geopolitical expansion. That changes the risk profile. Bessent's problem is structural. Trump wants a weaker dollar to boost exports and competitiveness. He wants aggressive borrowing to fund expansion. And he wants foreign investors to keep absorbing U.S. debt without complaint. Those goals contradict each other in the same market. At the same time, Washington is demanding Europe spend far more on defense. Bessent said it outright. European countries and Canada, he argued, hadn't met their spending targets and now needed to catch up. They've agreed to do it, he said. The question is how. European economies are not flush with cash. Growth is weak. Industrial subsidies are ballooning. Ukraine is still being bankrolled. Trillions in new defense spending can't be conjured out of thin air. The EU cannot raise that much new debt without risking its own bond markets. That leaves one option: sell assets. The market is already pricing that risk. The U.S. 10-year Treasury yield surged to 4.3% before settling slightly lower, nearly 20 basis points in days. That's not normal repricing. That's fear of forced selling. Long-term bonds are being dumped because investors are bracing for a wave of European liquidation. Higher yields don't stay confined to bond desks. Borrowing costs rise across the economy. Mortgages get more expensive. Corporate expansion slows. Consumer credit tightens. 70% of U.S. GDP depends on consumption, and consumption depends on cheap credit. When yields jump, the economy starts to wobble. The labor market is already flashing warning signs. The U.S. now has more job seekers than available positions. There are only about 0.9 job openings per unemployed worker. Roughly 7.8 million Americans are unemployed, while openings have fallen closer to 7.1 million. That shift unfolded during the first 9 months of Trump's renewed tariff push. If Treasury yields continue climbing, those numbers will deteriorate fast. And then there's Japan. Japan isn't just another holder of U.S. debt, it's the largest. More than $1.2 trillion in treasuries sit on Tokyo's balance sheet. Those reserves exist for one reason, to be used in moments of extreme stress. Japan is approaching one. After the prime minister called a snap election, Japanese government bonds came under pressure. Yields exploded. The 30-year and 40-year JGBs jumped more than 25 basis points in just a few days. That's a violent move in a market built on stability. Investors began questioning the currency itself. The yen remains down roughly 34% despite multiple Bank of Japan rate hikes. The trend? Yeah, it just hasn't reversed. Japan has intervened before, selling dollars to support the currency. It worked for about 6 months. Then the pressure returned. The underlying economy remains weak, and capital keeps flowing out of yen assets. Now Japan may need to intervene again. That means selling dollar reserves. Life insurance companies and large funds are already adjusting their positions. The Japanese finance minister went on camera to calm markets, never a reassuring sign. Equity volatility in Tokyo is rising as higher yields crush growth expectations for Japanese companies. Scott Bessent knows exactly what this means. He publicly blamed turmoil in U.S. and European bond markets on Japan, pointing to what he called a 6 standard deviation move in Japanese yields. He said he had urged his counterparts in Tokyo to stabilize their market because the spillover was global. German yields up, French yields up, U.S. yields up. And then he said the quiet part out loud. It had nothing to do with Greenland. Markets didn't buy that explanation. When yields rise everywhere at once, investors aren't isolating a single cause. They're connecting them. Trade wars, defense ultimatums, reserve stress, fiscal expansion, political risk, all of it is being priced simultaneously. Canada's Mark Carney finally said what many allies have been thinking. The rules-based order, he argued, has collapsed. The United States has shown it no longer feels bound by the system it built. Invoking that language no longer changes behavior. Decoupling is accelerating. New alliances are forming. Economic blocs like BRICS are growing stronger, not weaker. Capital follows structure, not nostalgia. If European funds keep reassessing exposure, if Japan is forced to sell treasuries to defend the yen, and if China continues trimming holdings, the U.S. bond market loses its shock absorbers. Demand thins, volatility spikes, borrowing costs climb into a slowing economy. The danger now isn't a single sell-off, it's sequencing. Once one pillar moves, everything else is forced to react in the wrong order. Inside United States banks, that reality is already being modeled. JP Morgan and its peers are facing a dual squeeze, rising long-term yields hammering bond portfolios and weakening credit demand as consumers pull back. Bank funding costs are drifting higher at the same moment Treasury auctions are getting heavier. That combination is toxic. It's one reason financial stocks cracked alongside tech instead of acting as shock absorbers. Scott Bessent understands that timing is everything. The Treasury can survive foreign selling if it's gradual and isolated. What it cannot survive is synchronized selling driven by unrelated domestic crises abroad. That's why Japan scares Washington more than Europe. Japan's problem is not policy credibility. It's arithmetic. The Bank of Japan has tightened, but inflation-adjusted yields remain unattractive and capital keeps leaking out. Life insurers, pension funds, and regional banks are under pressure as long-dated JGB yields surge. The moment domestic institutions need balance sheet relief, dollar reserves stop being strategic assets and become liquidity tools. Selling treasuries stops being political. It becomes mandatory. China has already normalized that behavior. Beijing's steady drawdown of United States debt wasn't loud, retaliatory, or emotional. It was administrative. Month after month, holdings declined while reserves diversified elsewhere. Markets learned to live with it because, well, Europe filled the gap. But if Japan joins that pattern, there is no replacement buyer of scale. And honestly, that's where Donald Trump's pressure campaign kind of backfires. By demanding Europe pay more for defense while at the same time threatening tariffs and territorial leverage, Washington is forcing European finance ministries into, impossible trade-offs. Raise defense spending without new debt or sell assets to fund it. The United Kingdom and France have already stretched fiscal credibility. Germany is constrained. Southern Europe is, well, tapped out. Selling United States treasuries becomes the least politically explosive option. Academia pensions move didn't shake markets because of its size. It shook them because it reframed treasuries as a moral and political exposure. Once that frame enters institutional committees, allocation models change permanently. Even small reallocations compound when copied. Mark Carney's intervention matters because it signals elite permission to rethink assumptions. When a former central banker and sitting Canadian leader says the rules-based order is finished, portfolio managers hear something different. The old anchor is gone. That really accelerates experimentation with alternatives. Local currency trade, bilateral settlement, commodity backing, and blocks like BRICS. This is how fragmentation looks in real time. Not a crash, but these, parallel exits. China trims quietly, Europe hesitates, then hedges. Japan prepares for intervention, banks brace, yields rise, growth slows. Everyone waits for someone else to blink first. Scott Bessent can ask allies not to escalate. He can blame Japan's bond market for global spillovers. He can deny Greenland has anything to do with yields. None of that changes the underlying dynamic. Treasuries are no longer being evaluated purely on inflation and growth. They're being evaluated on alignment risk. Once that happens, the old hierarchy disappears. Not overnight. But, yeah, decisively. And markets already know it. Bessent can urge calm, Trump can escalate pressure, but markets move on math, and honestly, the math is changing fast. Once confidence in United States Treasuries starts fracturing among allies, it doesn't snap back on command, it spreads, quietly at first, then all at once.